Just before the break, we told you that Libor once again had risen to 46 basis points. This is the London interbank offered rate. It is the average rate at which big banks lend to each other. It has been rising. Some see it as an indicator of stress in the banking system, but it also tells us a lot about what's going on in the money market. And for more on Libor, we're joined this morning by Michael Pond, interest rate strategist at Barclays Capital. Michael, the Fed and the ECB have moved to inject liquidity into short-term debt markets, but via swaps. But it really hasn't taken the pressure off Libor yet. How come?
Well, what we're seeing is continued concern over whether this sovereign risk issue, starting with Greece, but potentially spreading to Portugal, Spain, and other European countries, ends up hitting the financial sector. That panic, if you will, started about 2 weeks ago with a Moody's report showing concern that sovereign risk might spread into financial concern. Remember, back in the fall of 2007, Libor was really the canary in the coal mine, the first real sign of financial stress.
Michael, I mean, as you say, signs of financial stress, and as we know, when even banks don't want to lend to one another, that shows increasing fear. How many basis points does this European debt crisis represent? Well,
since early March, Libor has gone up. 3-month Libor has gone up by about 20 basis points. So it's nearly doubled from 25 up to now 46. So 46 is still low by historical standards for sure. But again, it's the pace of increase that have got some concern. And it's not just Libor, it's many markets out there. So it's equities, it's the fact that gold has been rising, commodities have been falling. Again, there's signs of financial stress in most markets.
Michael, given the fact that we have seen these central banks move and yet Libor continues to rise, does that tell us that this is strictly a credit and counterparty risk issue as opposed to a liquidity situation?
That's right. That's right. So, again, the markets really need to see signs that these liquidity injections from the Fed and other monetary authorities are going to work, in addition to the bailout package that was announced about 2 weeks ago.
Michael, I mean, you guys published some research earlier saying could 60 be the new 50? So, in other words, from here, where do we go for the Libor rate?
Well, again, in the near-term, markets could settle down and Libor could come in, but we do expect Libor to continue to rise over the next several months. Now, part of that is not just what's going on in Europe, but potential from concerns over in the U.S. through some of the financial regulation that's potentially going through. If Congress were to take away the too big to fail measures, where banks aren't seen as supported by the government, that could actually put downward pressure on U.S. banks.
Michael, thank you so much. That's Michael Pond, interest rate strategist at Barclays Capital, talking to us about the significance of the rising Libor rate.